Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I decided to share with you one of my favorite slides from the Investing in Personal Finance Basics course I had previously recorded. I compared the different types of investments and give you an idea about the types growth, cash flow, liquidity, tax efficiency, etc. as you try to decide what class or classes of assets you should invest in. If you like the content, check out the course on the website. The link is in the description. Note that it includes an hour of one-on-one video call with me. Investment comparisons. I think this is my favorite slide out of the entire course, where we compare the different types of investments and I give them a letter grade. So A is very good and F is very bad. We'll look at them in several different ways. So downside risk protection means how safe are these as far as going down? What could happen to my money to the downside? Appreciation is how much is this going to make me? Can it make me a lot of money or is it not going to go up very much? Leverage means am I able to borrow money in order to purchase this type of asset? Liquidity is am I able to get my investment out? Maybe not at the price that I paid or the price that I want, but am I able to get money out is what liquidity means. Control means do I have any say in the running of this asset? Cash flow is does it pay something like dividends? Am I going to be getting money in my account every month or every quarter? Tax benefits, how good is it with taxes? Am I going to be paying a lot of taxes or not so much? And inflation hedge, is this a good investment during times of inflation? So we'll start off with stocks. Downside protection, I call it a B minus. Stocks can certainly go down. Individual stocks can go bankrupt. If you have an index ETF that you're buying that is following stocks, you could go down 20% in a bear market every 4 or 5 years. You could go down 30% in a pretty significant bear market. Appreciation is an A. Stocks will, in the long run, outperform pretty much everything. Leverage is a B. You can use a margin account where you can borrow in order to purchase stocks. But if you go to your bank and you say, hey, I want to buy some mutual funds, they're not going to let you use those as collateral for a loan. Interestingly enough, they will lend you money at RRSP time for an RRSP, but not if you're doing it in a non-registered account. Liquidity, you can hit the sell button and have your money in your checking account the next day at worst. Control is a C. You don't really have much in stocks. I mean, there are the annual general meetings where you can vote or you can fill out forms to vote, but overall, you're unlikely to get access to the CEO and be able to tell him or her what to do. A cash flow is a B. Stocks will pay dividends. Certain ones will. They can be a quarter of a percent a year, or they could be 5 or 6% a year. So depending on which ones you choose, but on the average, the Toronto Stock Exchange Index pays about a 3%, and the US pays about a 2.2%. Tax benefits, I would call an A in a non-registered account. If you choose the right types of dividend payers, they are taxed very leniently. And when you sell a stock that went up in price, you will only pay taxes on half of the proceeds. In an RRSP and a TFSA, those are slightly different. You could hold anything in there and get taxed the same way. Stocks, just because of their performance, are considered a fairly good inflation hedge. When inflation is high, stocks end up going low. So they're actually not an inflation hedge from that perspective. But over the long run, stocks have good enough performance, let's say 8, 9, 10%, that they will outperform inflation, which should be 2 or 3%. So that's why I give it an A. Moving on, we are going to look at bonds. So downside risk protection, I give it a B. They can lose value as interest rates go up. Otherwise, they're generally pretty safe. Appreciation, I give it a D. You could argue for a C as well, but bonds are not going to be the main engine of your portfolio. It's going to be the stocks. Bonds are there for safety. Leverage, I give it a B. You can still borrow to buy bonds in a margin account as well. Bonds are quite liquid, depending on which ones you buy, but generally you can get your money out fairly quickly. Again, no real control other than at the AGM. Bonds, they do pay interest, and so I would argue that they will have better cash flow than stocks will. In early 2023, as interest rates came up, bonds went down in value, but now they are paying higher interest, and so they are performing better from a cash flow perspective than stocks are today. Tax benefits, I would give it a B minus. Bonds pay interest, and in a non-registered account, bonds will get taxed heavily. They will be taxed in the other income column for the interest. Bonds can gain and lose value depending on interest rates. And so that way that ends up being capital gains or capital losses. So that will be a little bit more tax efficient in a non-registered account. And finally, inflation hedge, they are not at all an inflation hedge. In fact, when there's inflation, interest rates will go up, which will make existing bonds have capital losses. They will make existing bonds worth less than they were previously. So they're definitely not a good inflation hedge. The new bonds that come out will pay higher interest, and you could argue that they are going to be matching inflation from that perspective. Next, we have real estate. Real estate is generally considered pretty safe. Obviously, in 2022 and 2023, we're looking at downturns in the US and in Canada. In US in 2008, they had the mortgage crisis where you had significant downturns in real estate prices by 60, 70%. So real estate is perceived as safe, but you could argue that it's not. I'm giving it a B plus because generally investment real estate goes up at the rate of inflation, so maybe 3%, and then you should have some cash flow from that as well. Appreciation, again, I would give it a C because it goes up at the rate of inflation. What we've been seeing for the last decade through the the 2010s and the beginning of the 2020s has been caused by super low interest rates, which made capital really cheap, and it made the carrying costs really cheap. And so that drove the prices up. Everybody knew that wasn't sustainable. And of course, now we're paying for it. So in the long run, appreciation is at the rate of inflation. There is very good leverage for real estate. You can borrow to buy real estate, and everybody will happily lend you money against it, despite the fact that it can go down. For an investor, you have to put 20% down, and so that gives the bank some protection. And there is, of course, the CMHC insurance that you're paying for as well. So the banks are well protected, and they're more than happy to lend you money. Liquidity, not that great for real estate. It takes months to sell real estate, and it may take months to close, especially if somebody else has to sell their own property in order to be able to close on yours. You can get a home equity line of credit against real estate to get some of the money out, but liquidity means actually selling the asset. So I wouldn't make real estate liquid whatsoever. You do have a decent amount of control over an investment property. You can somewhat control the renters depending on the province where you are. You certainly cannot control City Hall or your neighbors. If your renters decide to stop paying rent or damage the home, you're obviously not able to do anything about that. Cash flow should be pretty good. If you have a cash flowing property, you should be able to get a couple of percentage points a year for sure, positive cash flow from the rent. Tax benefits, you could argue there's some good ones. Any money that you spend on the investment property is considered a tax write-off. The rent is taxed as salary. However, it's taxed in the other income column in the tax table, which obviously makes it harmful to your tax picture. Interestingly enough, rental income builds up RSP room, which I found out recently, which sounds kind of odd. The appreciation in rental properties is capital gains once the property gets sold. So you get taxed only on half the appreciation, which is quite nice. So that's why I'm sort of giving it a B. Inflation hedge. Real estate is considered to be an inflation hedge because it goes up at the rate of inflation, which should be 2-3%. In 2022 and 2023, we've had significant inflation and real estate has gone down. This is because interest rates had also gone up. And interest rates are causing mortgage rates to go up, and that causes the carrying costs to go up. And so people are not willing and able to pay as much for their real estate anymore. Private equity. So this is the private investments where you're investing in a project that a company is doing. Downside risk protection, I would say poor. I've had one private equity investment which has been a total write-off. The $10,000 that I gave them is gone, and I'm just begging and pleading with my accountant to recognize it as a capital loss, so I can use it to offset other capital gains. It can certainly go down. I've had others where I'm going to get my original money back and be thankful for it. And of course, inflation has eaten away at it. It does have a good shot at some decent appreciation. So I've also had properties where I've given them $15,000 for an apartment building. They paid me some amount of cash flow while they were stabilizing it and putting renters in there. And then 3-4 years later, they gave me back $25,000. So, like, to me, that was a good diversification. It got me into real estate, and it had some good appreciation there. So, definitely something to look at with private equity. There is the downside as well, though, that I mentioned. Leverage is non-existent. You have to come up with the money on your own. If you're pulling the money out of your own HELOC, obviously that's up to you. That ends up being secured by your real estate, but nobody will lend you money to buy private equity, or at least not that I'm aware of. Liquidity is worse than bad. These are long-term investments, depending on which one. It could be from 2 years through to 5 years. And I've had an investment for 6 years, which I'm not able to get out of. So there's absolutely no liquidity. It's usually the company running it that makes the determination that we're going to sell, and here's your money back, and here's your profits. You have generally no control on some projects. You might get a vote for something, but generally it's the company running it that's making all the decisions. So I wouldn't say you have any semblance of control. Cash flow, depending on the investment that you choose, there could be some good cash flow. I own a REIT privately called Centurion REIT, which on the 15th of every month, I get $200 in my checking account, like clockwork. You could set your watch by it. Others said, well, we have to do this, and then we'll stabilize the building, and then you're going to start getting cash flow. And that was like 3 years ago, and I haven't seen any cash flow yet. So I choose investments that do pay me some sort of cash flow, but the company running it could very easily choose, well, we're not doing very well, so we're not going to pay anything out this quarter. And that's basically it. So I give it a B+ based on that you can choose good cash flowing investments, but it's definitely not in your control. Decent tax benefits, at least with the ones that I've chosen. So the ones that I've chosen is I give them money. They will pay me back over the course of those 3, 4, 5 years. They will pay me something back. But for tax purposes, that cash flow is considered return of capital. So it's not taxed. They're giving me my own money back. What it is doing, it is lowering the cost of the investment. So if I gave them $10,000 and over the 3, 4, 5 years, they've given me back 2, my cost is now 8. And then when that investment sells for 15, I pay capital gains at the end on the 7, the 15 minus 8. So from that perspective, in a non-registered account, it is taxed very nicely. So I look for those specifically. Is it an inflation hedge? I kind of give it an average, kind of just based on the performance. If you choose the right investments, the performance will do better than inflation, but it's not specifically linked or targeted at inflation. Startups and various businesses, absolutely no downside protection. It could fail and go bankrupt, and a lot of them do. That's why anybody who invests in startups makes sure that they have controlling interest and they are going to make a mint if it does actually go right. If it does go right, you can have very good returns. So I think they do have good appreciation. They are probably the extraordinary startup or business that makes you a lot of money. Definitely no leverage. Nobody will lend you money when you say, I'm going to be investing in a startup. You have to come up with your own money, whether you're borrowing it or what have you. That's up to you. Liquidity is probably poor depending on the investment. You may not be able to get your money out. The shares may not be liquid at all. You may not be able to find another investor to take over your shares. So I give that a D. You might have some semblance of control depending on whether you have controlling interest or not. The people who started the business may want your input or may actively discourage you telling them anything and want you to be a silent partner. So it just depends on what business you invested in. It's probably not going to have very good cash flow. You might be able to pull some money out of the business. You might initiate some sort of a dividend payout once the business is up and running and it has positive cash flow. But generally, the business model is there's some sort of a great business idea that needs money to be implemented. You give them $100,000. They grow the business. It becomes self-sustaining and it runs on its own. It runs, makes a profit, and then it goes public, and that's when you cash in. And at that point is when you would get the cash. I wouldn't say there would be any sort of monthly cash flow along the way. Tax benefits, yes, just because you own shares. If you lose the money, you would get a capital loss as well. So you could argue there's some decent tax benefits. And is it an inflation hedge? Not specifically. I would argue that if it has good performance, it will outperform inflation. But otherwise, there's nothing that links it to inflation whatsoever. And finally, gold. Downside risk protection, I would argue not very much. Gold is quite volatile, in fact. People think it's a safe investment, and it's not. It's quite volatile, and it's actually more to do with fear, where something bad is happening in the stock market, and people are either going into bonds or people are going into gold, and that's why gold is appreciating, because people are afraid everywhere else. But if people feel fairly safe, they're going to start getting out of gold and getting into stocks because they now feel more comfortable. Appreciation, I would argue a B at best. I would argue maybe even lower. To me, it's sort of range bound between 1,200 to 2,000 per ounce. It's not really doing very much. It's something that I've never invested in, and because it doesn't have any underlying utility, because gold is just worth whatever somebody's willing to pay for it. You can't use it for anything. You can't grow food on it. It doesn't kick off any cash flow. You can't live on it. And there's no profits unless somebody is bidding up the price. So I would say appreciation is average at best. Leverage, again, I don't think anybody will lend you money to buy gold. A bank might feel better about it than about private equity or startups, but gold isn't really something that you can say, hey, can you lend me money against this? Liquidity is good. You can get your money out. You certainly have no control. Let me go back to the liquidity. If you have a paper version of gold through an ETF, then you can sell it just like a stock and get out of it. If you have gold coins, then you need to store them and you need to go and visit your local money changer gold changer. And there's going to be fees and so on. So the liquidity is probably a little bit worse, but I'm assuming that you're using the paper version of all of these. Control, no, it's the world price that you're getting for your gold. You have absolutely no say other than buy or sell. Cash flow, absolutely none. So that's one of the reasons I'm not a huge fan. Tax benefits, if it goes up in price, you get a capital gain. So in a non-registered account, it's taxed at half. You can write off capital losses. As far as being an inflation hedge, I think I touched on it, but it's not really the inflation hedge everybody thinks it is. It is really just more of a fear index. And because of the performance maybe not being that great, I wouldn't even say that it outperforms inflation just based on its return. We've had inflation all the way through 2022, and gold has done nothing but go down. So I would argue against it being an inflation hedge. And then finally, we have the latecomer of crypto. I'm not a crypto fan either, so let me preface what I'm about to say. You're probably seeing a lot of F's there. It's worth whatever the person next to you is thinking that it's worth. It is super volatile, both up and down. I certainly wouldn't say there's any downside protection at all. It lost 60% of its value through 2022. It had good appreciation prior to that, but you're really just depending on other people bidding up the price. It has no intrinsic value, and so the appreciation, I think, could be anything from an A to an F. Leverage, not that I'm aware of. Whether anybody will lend you money to buy crypto, I don't think. Liquidity, you can certainly get out quickly. You can probably get out of crypto quicker than you can out of stocks. You have zero control. You basically are a price taker and you get whatever somebody's willing to pay for it. No cash flow. There are exchange traded funds that use option strategies because of the volatility of crypto to make cash flow happen, but crypto itself definitely doesn't have any cash flow. Tax benefits, you absolutely have to report. The government is able to track whether you have capital gains or capital losses. So if you think that your gains are tax-free, like maybe it used to be in the good old days, in the wild, wild west of crypto, that's not a thing anymore. It is like stocks. I would say you have capital gains, capital losses, which get taxed preferentially. Inflation hedge, that's another arguable item. It certainly doesn't benefit from inflation. You could argue it acts independently from inflation. During 2022, it looked like it was acting as a risk asset. It was basically acting like technology and small cap stocks during 2022. So while the stock market was going down, so was crypto. It's not an inflation hedge. At best, it's acting independently, but I wouldn't use it to try to offset inflation. I hope you enjoyed the comparison of the different types of investments. The link to the course is in the description. If you disagree with my assessment, I'm happy to debate, so let me know in the comments. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section as well. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.